Welcome today to the 8th episode of the TVCRE podcast. Tayler and Drey here, and excited to be joined by Kirk Walton with GPWM Funds, situated here in Eagle, Idaho. Kirk, welcome to the show.
Thanks. I'm happy to be here.
We are glad to have you.
This is an amazing topic. Like I said to you earlier, I think this will be our best topic that we've covered so far. No offense to our other shows, at least, but I think maybe the most pertinent when it comes to the time frame right now and learning about what's going on in our valley. And I think because we have so much opportunity in our valley for opportunity zones.
I would agree, Drey. It's a timely topic. It's a hot topic, and there's a lot of moving parts with it. But it's an honor to be on your podcast. I love the podcast, and happy to help out and share what I know.
So first of all, Kirk Walton, who actually got to meet Bill Walton, tell us about your past and how you got to where you're at in your current position.
Well, I started with a wealth management firm in Irvine, California, national firm. I was in the Irvine office, and my niche was to work with corporate executives. We had over 300 of the Fortune 500 companies as clients. Wow. So straight out of law school, and I did well in law school. I had a full ride scholarship, and you know, I'm a tax lawyer and a tax geek and estate planning lawyer, and that was very beneficial in counseling ultra wealthy corporate executives on holistic planning, from tax planning to investments to estate planning to dealing with stock options. I started at that firm in the 90s, and some of my first clients were in Silicon Valley in the 90s. And I don't know if you guys are even old enough to remember the 90s and Silicon Valley, but I had a front row seat.
I was dialing up the internet in the 90s.
Yeah.
AOL.
That's right. 14, 15.
Yeah.
When I started, my firm didn't even have email addresses. So those of you in the audience who can imagine a period of time when there wasn't email, that was when I started in Silicon Valley. And some of my first clients hit it big through their companies, and then they would be, CEO of one company, get acquired by a bigger company, and then they would go to some other startup, and then I'd get to know the other people, the other executives at that startup, and then it would IPO, and so it just kind of snowballed from there.
A lot of wealth generated really quickly.
Immense wealth generated, and it was all about equity compensation, and stock. And so I became an expert on employment agreements, executive compensation plans, stock options, restricted stock plans, and I gave seminars in Silicon Valley, and I was killing myself working insane hours coming up from Orange County to Silicon Valley all the time, and made a lot of money for the firm. And my firm was on the auction block. They were getting acquired. Goldman Sachs ended up buying the firm. Wow. And right at the time that transition was happening, I came up to Boise on a marketing trip and fell in love with Boise. And so 20 years ago, I left my huge national firm getting acquired by Goldman Sachs and moved to Idaho, Eagle, Idaho, and worked out of a home office.
Eagle was a farm town.
And it was so much smaller then. I mean, the Eagle Road exit out to where I lived, dropped down the hill on Shinden by Target, and it was just pastures and horses for the most part. And so I've been here 20 years now. Started small. Most of my Silicon Valley clients came with me through that transition, and I have a great working relationship with every single one of them today.
So you continued to represent them in a legal capacity while you're here? Or?
Yep, and I handled, so we ran the multifamily office for several families. Okay. We did the tax returns, the investments, the multi-generational wealth transfer, estate planning, charitable foundations. You needed a athletic facility named after you at your alma mater. We could negotiate that and figure out that. Need a yacht, you want to buy a villa in Italy, buy an airplane. I've seen and had
Yep. It was the true family office experience.
Exactly. And
Now I got to ask a tangent. What's the craziest thing you've ever seen purchased?
I got too many stories.
Okay, I know there's got to be some good ones.
And I don't kiss and tell, so I can't go there. But
That's why he's good. That's
You know
why.
somebody has like some kind of weird
dude.
gold embossed engraved something.
Don't
or
get me
other.
started. But no, that's a good point, though. Discretion is an incredibly important part of my job. My wife doesn't even know who some of my clients are. The only ones she knows about are the ones that have met her and told her. I never even tell my wife anything. But as a lawyer, that's incredibly important in my profession. And so we were holistic and objective planners who approached things from the best interest of the client. We viewed ourselves. I grew and merged with my partner, Philip Olafson, who had a similar background coming up and then started his own. And we merged and then we've grown. And so that was Griffin Private Wealth Management, or GPWM. And that's what we were doing for many, many years. And the Opportunity Zone tax legislation came around as part of the Tax Cuts and Jobs Act of 2017. I don't know how much you followed the evolution of that tax legislation, but to give you a little taste, the last time there was a major overhaul or something like that, there would be advanced copies of the text of the tax legislation, and so people could comment and see what was going on. With the Trump tax bill, the Tax Cuts and Jobs Act of 17, there were last-minute changes, there were backroom deals, there was no advanced copies. I heard there were handwritten modifications on the final bill. I mean, it was happening around Christmas time, and we did not know what was going to be the final result. The talking points were all about getting rid of the state and local income tax deduction to give the finger to California and New York who didn't vote for Trump. So it was like getting rid of the deductibility of state taxes, corporate tax rates, overhaul, child tax credit, tax rate brackets changing. All of that stuff was the talking points. And one of the most powerful pieces of tax legislation in a generation was slipped in at the last minute with no fanfare, no notice, no discussion. I challenge you to find an article that talked about, in the press anywhere, opportunity zones as part of the Tax Cuts and Jobs Act of 17 prior to its passage.
Interesting. Crickets out there.
It just wasn't even on the radar screen, and it turned out to be literally the most powerful tax incentive in my entire career.
Wow. Well, it's a good example. I mean, I don't know how many attorneys we have listening, but whenever there's new legislation, it's an opportunity for you as an attorney to become a subject matter expert on something that it kind of resets the playing field, right, in some ways, and no one really knew what opportunity zones were. Here you have this opportunity to jump in and become an expert in it at the very outset.
Yeah, and that's what, cut to the chase, that's what ended up happening. And what's useful to your listeners is the opportunity zone tax incentive at its core allows people to avoid taxes or minimize taxes on any capital gain of any kind from the sale of anything. Real estate, crypto, stocks, personal residence, art, gold, collectibles, any capital gain.
Crypto and art and gold?
Yeah.
So this is new. This is something
any capital gain of any kind, and it's like a Section 1031 exchange on steroids. In fact, people who are considering a 1031 exchange really should educate themselves on the pros and cons of a Section 1031 exchange compared to an opportunity zone transaction, because there are some similarities and overlaps, and there's some key differences, and we can talk about that in a few minutes. But you owe it to yourself to get educated and figure out which is the right path for you. We're finding for most people, the opportunity zone provides an even greater tax advantage way to own real estate than going through a 1031 exchange. But I'm jumping ahead.
Well, that seems like it would be, right? Because still at the end of the 1031 exchange, there's going to be a taxable outcome.
Mm-hmm.
Unless you defer all the way through to
the
convey
day
the
you
property
die.
to your kids, right?
Yeah.
But still an estate tax.
If you're over the ceiling.
Yeah. So maybe.
But
So what's the basics?
let's get to the basics. Well,
the skeleton, I guess.
yeah, let's get to the basics of how the opportunity zone legislation works.
Okay.
Okay, so it's also important to understand how the regulations surrounding it evolved. The way it works is Congress passes a law. That's the statute, that's the tax code. And Congress empowers the Treasury Department and the IRS to promulgate regulations that give you the detailed rules. It's almost like Congress said, we're going to play football, and if you get a touchdown, the ball gets in the end zone, that's a touchdown, that's the basic rules. You go figure out the rest. And then you have somebody on the rules committee writing all the nitpicky, detailed rules of penalties and holding and how to interpret this.
Right.
And a whole lot can change through the regulation drafting process. This is important to understand because the tax law was passed in December of 17, but the rules weren't final until December of 2019.
Oh, 2 years.
24 months later, and even after that, there have been minor tweaks and corrections in 2020, and then extensions to things because of COVID relief. And I got to be honest, the first batch of proposed regulations that came out in October of 2018, 10 months after the thing was passed, the first batch of proposed regulations, and the statute itself on its face left a whole lot of holes and questions and was really unworkable right out of the gate. And so for that reason, a lot of people's first impression of this tax law was, nice try, Congress, but we're moving on. And it was if you didn't stay tuned into the program until the very end, the final episode, when you got the final regs, you missed it. Because by the time the final regs were out, they had dialed the needle so far in favor of the taxpayer. It was almost like there was a real estate developer in the White House when this was being drafted.
Somebody who's going to benefit right away from opportunity zone. I knew it was going to be established.
There are some of the things. So I'll tell you some of the rules and where they ended up. But some of the things we got because of the regulations that were drafted, not because of the core statute. But
thank you for clarifying that, by the way. That's a good tip to know that. That's kind of how that process can take place.
Yeah. So the rules are like this. Someone has a taxable event from selling something, land, real estate, your primary residence. A lot of our recent investors have come from people who have sold their residences. You probably know under Section 121, you can exclude up to $250,000 or $500,000 if you're married of capital gain on the sale of a primary residence that you own and occupy for 2 out of the last 5 years. Gain above that, which a lot of people who are selling homes in Eagle and Meridian and elsewhere around here.
Everywhere in Idaho right now.
Right. Yep.
Gain above that has been rolling into our fund, no tax. So the first thing is you have a capital gain event in a transaction to an unrelated third party. The gain portion of that transaction is eligible to be deferred through an opportunity zone fund. The basis portion of that transaction you can keep. So if you bought Amazon stock for $300,000 many years ago and you sold it for $1.3 million today, you get $1.3 million in cash in your brokerage account. Your basis, that $300,000, you can keep and do whatever you want with it, no tax. The $1 million in gain, you would have to pay tax on that. You now have a new choice on your drop-down menu. It's either pay tax or don't pay tax.
Or
which one?
Invest in an opportunity zone.
And so the way to not pay tax is you drop the $1 million into an opportunity zone fund. And I'll get to the rules about what the opportunity zone fund has to do to maintain its qualified status. You have 180 days from the date of the transaction in order to take advantage of the ability to not pay tax on that capital gain. The 180-day clock generally starts on the date of the transaction if it's something in your name. If you get a K-1 from a pass-through entity like a partnership or an S corporation or a trust, where that entity had a capital gain event inside of it and your pro rata share of the gain flows out to you on a K-1, your 180-day clock can start on 3 different dates, and you can choose. Talk about maximum flexibility. It can start on the date of the transaction if you want to. It can start on December 31st if you want to, or it can start on March 15th. Put a big asterisk next to March 15th. Assuming it's a full year entity and a calendar ending, December 31st ending entity, it'll start on March 15th, which is the due date of the tax return for that kind of entity, not including extensions. So most real estate partnerships, March 15th is the date. That's relevant because you 180 days from March 15th puts you at September 11th. Literally a month and a half ago, you could have still deferred gain from January of 2021.
Wow.
If it came through a K1. So there's this long window for transactions that come to you on a K1.
Okay.
So that's your choice. It's not an all or nothing thing. If you have $1 million in gain and you only want to avoid taxes on $200,000, you put $200,000 in and you pay tax on $800,000. And you put it into a QOF, a Qualified Opportunity Fund. And that's a special new tax-exempt vehicle that was created under the Tax Cuts and Jobs Act of 2017. Brand new code section, brand new tax-sheltered vehicle type, brand new entity. Qualified Opportunity Fund. You'll see it abbreviated QOF. So then once you do that, your job's done. Now all you got to do is sit back and don't pay tax for a while. The QOF, it has certain rules that it must follow, and they are, in general, a certain period of time within which it must take the money from the investors and deploy it into either operating businesses, which you almost never see, or real estate, which you almost always see, that's located in certain places that are called opportunity zones.
Okay.
It must also do something with the real estate in those places. It's not enough to just buy real estate in those certain locations. Because Congress, the point of it, if you go back to zoom out to the big picture, what's the public policy behind the statute? It's to motivate people to take money out of the stock market that's just sitting there and put it to work in redeveloping certain areas of the country that Congress in their infinite wisdom decided needed an infusion of capital.
Right.
Where are these opportunity zones? Well, they're literally everywhere. They ended up covering almost 16% of the surface area of the country. And there's an interesting backstory of how a place got determined to be an opportunity zone. We live in Eagle, and you're all familiar with the real estate market here, obviously, in the Treasure Valley. Idaho has some of the best opportunity zones in the country. Meridian,
Downtown Meridian.
Idaho, is an opportunity zone. Nampa is an opportunity zone. McCall, Cascade, Donnelly are opportunity zones. Mountain Home has an opportunity zone. These are areas that are rapidly growing, and you don't need to dangle some enormous golden tax carrot in front of me to make me want to go and buy real estate
Pretty
in those
attractive
markets.
already. Yeah.
And how did that happen? Well, if you go back to how they determined what an opportunity zone is going to be, the country is divided into census tracts, which is kind of like zip codes. Census tracts, and they keep redividing that, by the way. They keep redrawing those census tract lines. But the 2010 census and 2010 census tracts and the economic data from the 2010 census was the baseline screening of whether a census tract could be an opportunity zone or not. And 40% of all of the 8,300 census tracts out there passed the statistical screen and could have been an opportunity zone. Yeah. So just about half the country could have been an opportunity zone. Each state got to determine in whatever manner they wanted which of the census tracts in their state they wanted to designate as an opportunity zone. And they could take basically 25% of the census tracts that passed the screen. So you ended up with 11% of all census tracts are opportunity zones, covering about 16% of the surface area of the country. And they're literally everywhere. Yeah. And they're definitely not all created equal. But it's because they started with economic data from the 2010 census.
Yeah. Okay, and our area has seen some changes since then.
In the last 12 years, there's been a little bit of growth in certain of those markets. Now, I should tell you that one of the criticisms of this program, the biggest criticism, if you were to encapsulate the common thread through all of the criticisms that are out there about this program, is it's too good to be true. It's too generous to the wealthy. It's too good to the investors. That's in general the thread. But there is some pending legislation, which we'll get to later on, that would kind of sunset certain opportunity zones and make them no longer opportunity zones, although the stuff that's already started there would be grandfathered in, and give states another bite at the apple. Because after the statute was passed, before anyone even understood the rules, before the rules were even written, the states had to choose within a few months where their opportunity zones were going to be. And nobody even knew what an opportunity zone was going to be.
And that's what we had, like I had told you, I sat at a ULI training and someone had spoken about opportunity zones, and I don't remember which district they were from, but one of the local counties, and they said, we were told about this opportunity zone thing, and we literally had such a short amount of time to process this as a department, and we ended up just kind of going, that's it, right there. We'll just put it right here.
Yeah, so that's another one that's a great observation. It's one of the criticisms is we didn't really know what this program could do when we had to choose where the opportunity zones would be. There's pending legislation that we really hope will pass and has bipartisan support and has been introduced in both the House and the Senate with a long list of high-profile senators and Congress people backing it. I do think it'll pass hopefully by the end of the year. And one of its provisions, if passed as it's currently drafted, would sunset certain op zones and create new ones.
Yep.
And Meridian probably is the poster child for the kind of opportunity zone
It's
that
going to get sunsetted.
Well, you would have thought like a district like Garden City, would have been a prime target for an opportunity zone or a redevelopment opportunity.
Yeah.
So,
All right, so back to our story. You got a capital gain. You put your money, the gain within 180 days, into your QOF, Qualified Opportunity Fund. Opportunity Fund takes the money, goes out and buys land or real estate in these opportunity zones. Then it has to either put it to new use, improve an existing building, or do new construction. If it does that, and you continue to own your partnership interest in the QOF for 10 years or longer, there's no tax when you exit this. You can own real estate in opportunity zones like Meridian, Idaho for 10 years and pay no tax on the exit.
Wow.
One key point here is 10 years is just the bare minimum. And almost every opportunity zone fund I've ever looked at is targeting a 10-year time frame. That is akin to opening a Roth IRA with the game plan that as soon as you've owned it 5 years and you reach age 59 and a half, closing it down and cashing it out, because you can do so completely tax-free at age 59 and a half with 5 years of ownership of a Roth IRA.
but that's short-sighted
Why do you say that?
because you can keep gaining on it.
You
over
can
time.
keep going.
Right.
As far as I know to this day, and it baffles me because it's plain in black and white in the final regulations, that you can continue to recycle cash flow into more and more and more. So if you think 10 years of tax-free growth in real estate is good, try 20.
Right. Why not more?
25. You can roll this out for 25 years and,
wonderful.
and get all of the depreciation deductions that normal real estate is allowed to take, and all the growth and the appreciation and value that real estate occurs. Could you imagine owning land in Meridian 25 years ago that you bought and selling it now without tax?
No.
It's crazy.
That's what this
I mean,
does.
that's generational wealth. That changes
Correct.
your family, right? That changes
Correct.
what your family's family will do forever.
But what if you need some money? You don't want to put your
Tie it
money
up
away for
forever.
25 years.
Yeah.
The Opportunity Zone final regulations allow massive flexibility in the ability to return cash to the investors. The key is you have to own your interest in the partnership for that long, at least 10 years, but up to 25. But once the building is, let's say you go out and you find an old building and you rehab it, and then you put a new tenant in. What do you normally do when you get a building and you put a new tenant in? Normally
that
you
bad
sell it because it's up in value.
Yeah.
That's what we've been doing forever. If you're a tech guy and you hit a bid in the stock market because of your tech company, one of the best diversifiers is real estate. Real estate is such a great asset class to own, and so that's why we've been heavy investors in real estate forever, is because of that. You build, you develop, lease up, stabilize, sell it, start over again. That's the steepest part of the IRR curve.
Yeah.
With the Opportunity Zone, however, a better way to monetize it is go to the bank and refinance. And the final regulations allow you to take this building that's built, leased up, stabilized, and instead of selling it,
You pull your money out.
pull your money out and cash out refinance. Continue to own and operate, milk it for cash flow, continue to get depreciation deductions, which, by the way, no depreciation recapture on the sale
Isn't that
of the.
huge?
You get
I mean, that's a
free
game changer.
depreciation deductions. To the CPAs and other tax geeks out there, yeah, that is actually the rules. No depreciation recapture on the sale, even though you get enormous depreciation deductions. And we'll talk about that in a minute. But you can get money out from the cash out refi. And as long as the debt
So
is...
you have your money pulled out, you're getting your cash flow, you're getting the benefits of the depreciation, which is actually income at that point if you're making enough on your taxes. So, I mean... I'm sold. Obviously, I was sold before, but now I'm sold again. I'm like sold
where
4
do I
times over
sign?
again.
So if the investor needs money...
Yeah, talk about the cash out refi a little more. What are the rules
Well,
there?
like we bought an old Sears in Melbourne, Florida. Give you an example. We bought an old Sears. It was vacant in Melbourne, Florida. It came with 14 acres of a parking lot. It was a standalone Sears, not a Sears that was an anchor tenant to a mall. We wanted to put climate-controlled self-storage in this. It's in a high-growth market. There isn't a lot of self-storage near there. And we like the size of the lot, 14 acres on a corner of two busy intersections. We paid all cash for it. We were able to sell off a portion of the excess parking lot, the stuff closer to the busy intersections, which was higher value. Yep. We sold off about half the land. And then we got a construction loan and took out a refi as part of the construction loan. We have already, within 24 months, recovered 100% of the capital that went into that project. And we've recycled that because we could have, it went from the project, there's a LLC that owns this land.
Right. Yes.
It goes from that LLC to the LLC that is the QOF, the Qualified Opportunity Fund, that people put their money in. From there, there's a choice. We can take that money and send it back to the investors if they wanted. It would go to them tax-free. Mm-hmm. Or if they don't need the cash flow, it can stay inside this QOF and go into another Opportunity Zone project. Mm-hmm. Meanwhile, the construction loan is funding the remodel expenses of the old Sears into climate-controlled self-storage and funding the startup phase of that. Once it's leased up and stabilized, we will be able to cash out refi again and return more money back to the fund. Yeah.
And then have the same choice again. Yeah.
But we'll still own and operate, still get cash flow, still get depreciation deductions on the thing. And then in 10 to 25 years, we'll be able to sell that land with no tax on the exit while already receiving all of our money back tax-free and recycling it into another and another and another.
And starting that process again.
Again and again and again. We like rehab. We're experts on rehab. We're doing a lot of rehab projects because it's faster to completion, faster to refi. Now, the Opportunity Zone ability to defer gain into an Opportunity Zone expires with transactions that occur at the end of 2026. So we only have about 5 more years to really be able to replant.
Under the current legislation.
Under the current legislation. The proposed legislation that's pending in Congress would bump that out 2 more years. But basically somewhere between about 5 to 7 years, we have the ability to recycle money back in the ground, recycle money back in the ground, recycle money back in the ground. So the smart money is doing that. They're recognizing that you can build this portfolio of properties, all of which will grow tax-free, all of which will give you massive depreciation deductions and cash flow. But for the next 5 to 7 years, let's just recycle. It's almost like planting a row of crops, harvesting the first harvest, and using that as more seed to plant another row of crops and another row of crops, and then getting a big, huge thing, and then...
It's called house money.
Yeah.
So is the idea then that if it extends to 2028 but does not extend again, that any projects that have been commenced at that point, you still have that 10 to 25 year holding period? Yep.
As long as it started before the thing sunsets, you have enough time, you have enough runway to continue to build it out, continue to finish the construction, continue to lease it up, continue to own it, and you're fine.
And one of the common critiques that I've heard, which I think is inaccurate after speaking with you, is that you don't have a full 10-year window. You only have until 2028, and at that point, you're not having the full benefit of the tax deferral, but that's not correct.
That's not correct. What is correct is most funds are targeting just a 10-year.
Yep.
And they're going to, I mean, it really is, it saddens me because investors see this opportunity and they're missing the big opportunity
which is
in
that
the
extra
Opportunity
15
Zone.
years of tax-free growth.
That's right.
Yeah.
It's like having a Roth IRA and having a stock in there that pays a dividend. The other thing that every other fund out there that I've seen does, takes the cash flow and sends it out to the investor. You don't even need to take the cash flow back. If you don't need it,
Let it sit, let it roll.
let it sit and go into another project and another
Let it
project.
keep rolling over and over again.
If you have a Roth IRA and you got a stock in there and it pays a dividend, you don't send the dividend check out to your checking account.
No, you reinvest that
Let it
thing.
go.
Yeah.
Right. And if you sell that stock, you don't take it out and put it in your checking account. You could.
Right.
And you don't hit age 59 and a half in 5 years and sell out, even though you could completely cash out, completely tax-free.
I get it, but there's no reason
But
behind it.
yeah, so we're the only ones that are doing it with this long-term approach, even though we're taking projects that we're trying to monetize as quickly as possible. So that's the thing. People hear this long-term ownership and they're like, oh, I'm never going to see any money for 25 years. No.
No, because you're getting it on the refis.
We want projects that can get to cash flowing and refi as quickly as possible so that we can recycle and do another and another and another. Or if the investor needs it, they can take the money out at that time.
Now, can some investors take the money and others roll it?
That's an excellent question. We have set up a structure where investors have the choice. Now, some of our investors have 25 million in capital gain or more. And we have 5 single-family funds like that, and we're talking to a few other families all the time. And we'll probably set up a couple more of those this year. And for those families, we'll set up their own QOF. And so when the money comes back for their portion of, like the Melbourne project, for their portion of that came back, each of those families could choose with respect to their own whether to take it out or replant. Most people don't have 25 million. Apparently, that only happens to some people every other year. I don't know. But we have a lot of old investors that we were close with, who had 100 grand or 500 grand or whatever, capital gains, couple million, but not 8 figures. So we have created funds for them where you can, stack your 100,000 on top of everybody else's. And we have basically 2 tracks. They're parallel in the sense that they go into the same projects. They invest in the same projects. The only difference is on one of them, when the money comes from the project back to the fund, it gets distributed out to the investors.
Yep.
And on the other one, when
What
it
a
comes
smart way
back,
to do it.
it gets
Yeah.
replanted in the ground. And investors going in can decide what to do with their gain, whether to put it on the track where they're going to take cash flow out, or put it on the track where they're going to reinvest it for as long as this window's open, which, like I said, is about 5 or 7 years. After that, the reinvestment track is exactly the same as the other track, and in all likelihood, those funds will end up getting merged
At that point.
At that point in time.
treated the same. Yep.
I have just a generic question that I should have asked a long time ago, but I think I was operating under a poor mindset that I thought someone could buy an opportunity zone piece of land and own it personally and not own it within a qualified opportunity fund. Is that true? Can you still get the benefit by owning it just like as a personal or a
No, in fact,
singular LLC?
That's a very common misunderstanding. I hear that question all the time. In order to get the tax benefits, you have to do every single hoop, and it starts with first capital gain dollars only. Capital gain dollars from a transaction and with an unrelated third party only. If you if we go back to our example where you've got 300,000 in basis and 1.3 million sales proceeds and $1 million in gain, if you put the whole 1.3 million into the QOF, you'd actually have the split interest, where $1 million of it would qualify for all the benefits we're talking about, and 300,000 would be just like any other real estate partnership.
So I couldn't just come and say, "Hey, I want to throw in 300,000 with you. It's been a great year. I want to just put it in the fund."
I wish that Congress had written the law that way. If the true intent was to take money and improve these communities, you wouldn't think it would matter where the money came from. And yet, the rules are what they are, and we're stuck with them.
So you need to have a taxable event.
You have taxable capital gain in a transaction with an unrelated third party, and that's the first hoop. Then you got 180 days and all of the other stuff.
This is getting my strategy mind thinking. So then do you find people who own a piece of property, sell it to themselves who are an LLC, or is that because it's personally related somehow? Can you not do that?
That would be a related party
Because it's not
transaction.
yeah, so it has to
And
be.
in other areas of the code, related party testing is generally a 50% test. In the opportunity zone space, they actually lowered that threshold to just 20% of common control or ownership or relations from family or whatever. So it really needs to be a true independent arm's length transaction.
So what about an accredited investor requirement? Does that exist in investing?
For our
capital
funds,
gain?
it does.
Okay.
The tax code doesn't require that, but you'd be hard pressed to find somebody.
Any fund that wants to take money from a non-accredited investor.
Correct.
Are you still doing SEC filings as well?
Oh yeah, yeah.
Okay.
We have to do all the SEC. It's incredibly complicated to set up and manage an opportunity zone fund. We've been doing this since the beginning, and we're, like I said, we're on our 10th fund now, and we have projects across the country, and we're really proud of what we've been able to do. It caused a complete transformation of my personal practice. And when the tax law came out, coincidentally, we had 3 client families who were facing 9 figures in capital gains around the time the first batch of proposed regulations were out there, and the second batch wasn't out there. And I met another tax lawyer who was into the space, and became part of this forum where we'd meet weekly and talk about the pending regulations. We'd draft letters to encourage the Treasury Department. We had the 7 individuals inside the Treasury Department who are responsible for drafting these regulations come and speak to our forum on a Zoom call.
Awesome.
I have never seen the Treasury Department be more responsive to input from the community. And so that's where the regulations went from, nice try, Congress, to this is better, to, oh my gosh, we got this. There's no income in respect to decedent. I was floored. I didn't even know that one was coming down. I knew some of the other things that were coming down from whispers through the community, but income in respect to decedent, normally if you do this, and then you transfer your QOF to your children or to a charity or something, that triggers taxation on the gain that you deferred.
Right.
That's called an inclusion event. But income in respect to decedent doesn't apply here.
Wow.
You can, so we thought this would only apply to younger people. No, you can be a patriarch of some family and recognize the long-term benefits. You can set this, like you were saying, generational wealth. You can set this up, you can do it inside a grantor trust even, where all of the income tax bill that comes due, you pay out of your estate, which reduces your taxable estate. And all of the growth is outside of your taxable estate, income tax free from capital gains, no depreciation recapture to your heirs, no estate tax on the growth, no generation skipping transfer tax on the growth.
Wow.
Absolutely.
That's amazing. And we didn't have the opportunity to talk about that when we last met. Like, my mind's blown even further. That's amazing.
Yeah.
What an estate planning tool, right?
Yeah. So back to the last step. We've gone through the hoops. You got a capital gain event. You got 180 days. You put your gain dollars in, not your basis. You take your basis and do whatever you want with it. No tax. Give you some liquidity. The fund has a certain timeline when it has to deploy the money into certain projects. When it gets money back from a refi or something like that, it has up to 12 months to sit on that cash and decide where to redeploy it. Incredibly flexible. Long windows to look at stuff. Unlike a 1031 exchange where you've got this,
Down to the wire.
you got a gun at your head, you got 45 days to pick something. By the way, a 1031 exchange, you also have to roll over the whole enchilada.
Right.
With this, you only take the gain piece off the top and you can put your basis in your checking account and give yourself some liquidity and do whatever you want. Okay, when you do this, you have to file a form with your tax returns where you elect to defer the gain on the tax return. And then you have to file a form with every year from now going forward.
Yeah.
If you don't, the government is going to think that you got rid of your QOF.
Okay.
And that would trigger capital gain recognition from what you sold.
Okay.
Generally speaking, the gain that you put in comes back on your 2026 return. We've talked about how the money that goes in is used to buy real estate that's never taxed. But the original gain does come back on your 2026 return. It's included in capital gain on your 2026 return with the exact same type and character of gain. There was a period of time when there was a 10% discount and a 15% discount, and those things went away. But the current legislation that is pending as it's drafted would revive and reinstate the 10 and the 15% discount. Not that that's what this is about, but that's a nice little tiny cherry on top if it comes back.
Yeah.
So you got gains coming back in 26. Most people would panic about that. We had a lot of questions. One of the most common questions was, where am I going to come up with the money to pay the tax? Well, if you have your fact pattern of $300,000 in basis, 1.3 million in sales proceeds, $1 million in gain, the capital gains tax rate in Idaho is just under 30%. Where are you going to come up with 30% of $1 million to pay your tax and your basis?
Right there. Yeah.
The $300,000 in
If
cash.
you go out and spend it.
If you don't go out and spend it, you've got money set aside from the basis. So unless you have more than like a 4.5 or 5x like multiple, people have cash already from that, just from the basis.
Right.
So you advise them to hold that and wait.
You have to plan for that, and everybody's situation is different. Some people just have enough income, they're not worried about it. Other people, you have to plan for it. Most of our clients are so wealthy, honestly, that they've got liquidity outside, that they're not worried about that. The other thing is, if you have capital gain from the sale of a passive activity, and for listeners to this podcast who are interested in commercial real estate in the Treasure Valley, this is incredibly applicable to you. You sell a rental property or a commercial building or an industrial building, that's a passive activity for most people. You put it into the QOF. If the QOF does rehab projects like we do in particular, it'll throw off even more passive losses from the early years. Like I bought a casino. We bought a casino, something I never thought I'd say. We bought
Good old Reno,
Like that movie,
right?
We Bought a Zoo.
yeah, we bought a casino from Caesars in downtown Reno. It covers 7 acres, 2 city blocks.
Huge.
1.5 million square feet, 3 towers, 26 floors, 24 floors, 18 floors, almost 1,000 hotel rooms, and this massive sprawling over 2 city blocks. In fact, there's a 0.8 acre parcel 6 blocks away that's just vacant. We haven't even done anything with it. We also got the gaming license that came with it. Bill Harrah's grandfathered special rights gaming license came with this.
Do you remember when we went to
We
Reno?
ate there.
And we went to the
You go to the steakhouse?
We did. We went to the steakhouse in that hotel, right?
Oh, that steakhouse is famous, and it's downstairs, and Sammy Davis Jr.'s dressing room was there, and I got 1,000 stories. There's a submarine engine from a World War II submarine that is still operational underneath there as the backup generator. I got so many stories about this project, it's insane.
So,
But let me tell you why this is relevant. Unrelated to the Opportunity Zone tax law is a tax law called Qualified Improvement Property, QIP.
Okay.
And what this does is it's an incentive to motivate people to invest in rehabilitating, remodeling existing buildings. And the rules are anything we place in service this year that is money that was spent to remodel a commercial space, I can elect to deduct all of that this year when it's placed in service. And I have this enormous footprint of existing space. There's a casino floor, it's gonna be a grocery store. We got old restaurants that are getting rehabbed. The Starbucks is already open. We got office space, we got a new office tenant. All the money I spent on remodeling the restaurants, the office, we got some storage units going in the basement, all of that non-residential space, all of that base, the base floor plate on the main floor is more money is spent on that than cash that went into the project.
Okay. Of course.
And I get to deduct all of that in the year it's placed in service this year, which
100%?
means 100%.
Wow.
That's QIP. That's unrelated to the Opportunity Zone, but it dovetails with the Opportunity Zone because if you're a guy who sells a real estate asset, distill it down to simplicity. Let's say I have one investor. He had $50 million in capital gain. He put it all into one project like this Reno project. We've got about $60 million in cash. We've got $140 million in a construction loan, a $200 million total project. My first year write-off is more than $50 million. So that's going to generate to that pool of investors
significant.
a passive loss.
Yep.
If he has nothing else on his tax returns, the rules for passive losses, I'm sure most of you know, they roll forward from 2022 to 3 to 24 to 25
And
to
you got to
26.
offset passive income with it, right?
Right.
Yeah.
Passive income includes capital gain from the sale of a passive activity.
Okay.
So
Right.
someone who sold a real estate asset and triggered $50 million in capital gain from the sale of a passive activity,
Right.
that comes back on their 2026 return.
So you roll that passive loss.
The passive loss rolls
Wow.
forward, and there's no tax on the 26. They have capital gain come back,
Right.
and they have passive losses that are rolled forward, and they net against each other,
coalesce.
Yep.
and then there's no
And that
tax
wipes
on
it
the
out
26.
completely.
It's wiped out.
And so let's take a big picture overview, especially for people who are considering a 1031 exchange. The 1031 exchange, you roll over the whole enchilada. You don't get any new basis. You got a gun to your head in 45 days to pick the project.
Right.
And you're buying basically stabilized projects because it's really hard to do development in a 1031 exchange.
Right.
The opportunity zone, you take your basis out, so you have liquidity. You don't have to roll over the whole enchilada. Only the capital gain goes in. You actually do get new basis from the debt.
Right.
You will get basis from your dollars on your 26 return. In the meantime, you get basis from the debt, which we structure as qualified non-recourse financing.
Okay.
So you actually have basis, which allows you to take the depreciation deductions, which produce the passive losses.
Right. Right. That's awesome.
And with the 1031, you don't pay tax now, and you're not going to pay tax later. But with a properly structured QOF,
You can do the same thing.
you don't pay tax now because you deferred it. And if we play our cards right and continue to find rehab projects like we think we will and like we have been doing, you won't pay tax in 26 or hardly any. I mean, if every project's like my Reno projects, there'll be no tax in 26. But each project's different. But our Melbourne project's the same. We have a Sears and Braden's in Florida that's the same. We've got an old warehouse in Tulsa that's the same. All of those projects we're actually seeing in real time the K1s coming through, giving us losses in excess of the cash that have gone into the projects.
Okay. Wow. So then you
Mind-blowing.
get that, then you get the extra benefit under the opportunity zone.
Then you get and that's unlike a 1031 where
Which you got to keep rolling and rolling.
I got actual cash flow coming out that's more tax efficient if I need it,
Right.
or recycling for the next 5 to 6, 7
And those-
years.
Yeah, and those new projects, as long as they're a 10+ year hold.
No
in the
tax
fund,
on
no
the
tax
exit.
period. Yep.
So you've mentioned now Florida and Meridian and Oklahoma. How are you finding these areas in which you want to invest in? Like, how are you guys doing the research to determine where you want to do your next project?
Well, because we've been so involved in real estate investing for so long for our Silicon Valley clients, we have a good network of developers, people that we've worked with before and made amazing returns, even though we had to pay tax on it or whatever. Like, real estate is a great asset class, even when it's taxable. The fact that you can get it without tax just juices the returns by an order of magnitude that is off the charts. So that's our first thing. We had clients who had significant gains. Like any good wealth advisor, I looked at every opportunity zone fund I could find. I'm a reluctant opportunity zone fund sponsor. I didn't start out trying to do my own opportunity zone funds.
Right.
I
Just didn't find any that-
I looked at every opportunity zone fund out there, and they all missed the mark in these ways. They all had crazy high upfront fees. The average opportunity zone fund has a 10 to 12% upfront fee, which means fewer.
Is that spread out through acquisition fee
And the marketing expenses,
doc review,
all that stuff.
Yeah.
Everyone out there is doing 10 years in a day. Everyone out there is sending cash flow as soon as it's available out to the investors, rather than recycling the cash flow. And I understood the impact of this tax law and the rules as they were coming out. And so as the first batch of regs is out, the second batch, I'm getting word of what it's probably going to say and is almost out. And we've got guys whose 180-day clock is already ticking. And we're scratching our heads going, how come everybody's structuring it this way? These guys, it's almost like they just took old real estate investment, private equity structure, added a couple extra paragraphs for opportunity zone and rolled with it. Rather than think
Probably
about
exactly what happened.
how is
How
the
to
most
re-strategize.
efficient way to use this new tax law
the
for the
maximum.
benefit of the client.
Yep.
So we came with what's the benefit of the client, because that's what we've always been about for decades. It's what's best interest of the client. And that's how we structured ours. So then I called up some of our real estate developer partners that we've worked with and said, hey, do you have any projects in the opportunity zone? And they said, what's an opportunity zone? And I said, you're going to be sorry you asked that because you can't get me to shut up talking about opportunity zones. 45 minutes later, they gave me the list of their projects that are coming down the pipeline. We start spreading the word that we're looking for projects in the opportunity zones. There's a database I have access to. Anybody can find it on the internet. Novogradac has a good one. You can type in any address and it'll show up. And so we go down, oh, that one, that's in an opportunity zone. Okay, where are you at on that? Mm-hmm. Well, we're we're at due diligence, we're in underwriting, we're looking at this, da-da-da. The way it normally would go with these guys is they'd find a project, they'd commit to it, then they would take it to the street and try to raise money from, mom and pop, 100 grand here, $1 million there, 500 grand there, spend 9 months raising the capital for the project while their money's at risk because, and trying to get an extension, all this stuff. We say to the developer, look, what if we brought you one check? Mm-hmm. Let me make your life easier. We'll take that whole project down. Yeah. Okay, but if we do that, I need you to recognize that we're simplifying your life. We're giving you certainty, and we're going to be a repeat customer because we can do this over and over and over again. Mm-hmm. But you need to reduce your normal fees because you aren't doing all the work that you're normally doing. Right. So it's a win-win. It really is like buying wholesale for our customers. All of our best projects are word-of-mouth deals, off-market deals. The Reno casino, you guys got to come see that sometime.
Oh, I'd love to. We talked about that.
Maybe
we need to go back to Reno. Yeah.
So memories there.
The Reno casino came to us through our relationships with a developer that we had invested with on a project in Vegas before. And he got the deal through his relationships. And, same thing with our Sears. We've acquired a few Sears.
Ironically, that's what was supposed to happen with the Boise, Idaho Sears, right? And is that in an opportunity zone? Is the Boise Mall?
It should be. It's not. And the developer who owns that is the same developer who's that we've worked with. And it's not op zone, but we have the option to deploy capital into that project when they figure out what they're going to do with it. Yep. But we know that developer very well. We have got a good working relationship with them, and like all of our development partners, we're repeat players with them. And they keep bringing good deals to us because it's simple. If we have the capital and they have a really good project, we're going to back it because their compensation is fair and reasonable and not egregious. But we're negotiating against the developer. We want the developer to be fairly compensated, but not in an egregious way, because our own compensation and our investors' compensation is, opposite to that. So we're on the side of the investors, working for them and their money and making their money work to the best of ability. Whereas the other difference with most opportunity zone funds, you have a fund sponsor that is the same group that is the developer that is doing the project. Right. And then there's the development fees that are baked in down there that are not arm's length negotiated. Yeah. I've seen double tiered waterfalls. I've seen, excessive development fees down below that are not arm's length negotiated. And that's a real, detriment to those investors. So we looked at it, what can I do to protect my clients like I've always done and take advantage of this tax law to their maximum benefit? And that's how we came to the structure that we got. And like I said, it transitioned my entire practice. I no longer do tax returns. I no longer manage any stocks, mutual funds, muni bonds.
That sounds way more interesting and way more fun.
I've always loved the real estate side of things more than any of the other stuff. Right. But this is all I've done since the first batch of proposed regulations came out. This has been more than a full-time job. Yeah.
That's absolutely fascinating. It's a cool area.
Yeah, and we have projects.
Do you guys have any projects locally?
We have backed a project in Meridian, and we're excited about that. It's nearing completion. It's across the street from the new Meridian City Hall. Yep. And we've got a good working partner there, and we love that project. It's one of our few ground-up new construction projects. Most of our projects are rehab projects because with all of our projects, you can do a cost segregation study. And some other day, you know, I'm really scintillating at parties. You know, I can talk about cost segregation studies, estate
You go
taxes.
to a real estate investment party, you will be the man of the
you're
hour.
the guy.
Oh, man.
Yeah.
But save cost segs for another day. But in a nutshell, what it does is it allows you to take a lot of deductions now. And you can do that with anything, even new construction. But on rehab, it's like so much more of deductions that you can take now on rehab, which generate those passive losses now, which roll forward. I mean, if you have other passive income, the passive losses from the QOF will save you taxes right now.
Right now. Yep. On your next return. Yeah.
So I guess a good follow-up question is, who is your ideal client and how could they reach you if they wanted to reach you?
GPWMfunds.com is our website. You can find us there. My email is Kirk, K-I-R-K, at GPWMfunds.com. You know, reach out to us there. Our ideal client is someone who wants to pay less in tax and likes owning real estate. You know, and for those people who like owning real estate and want to pay more in tax, I appreciate your patriotism, and I'm sure government will spend it wisely. But I'm finding most people would rather pay less in tax.
And people who've had a qualified event, right?
Right. Anybody who's sitting on gains, taxed or untaxed. Here's the other thing. We have people who are turning over their stock portfolio trying to trigger gains to increase more. Because, I mean, let's say you love Amazon and you've got other money. Well, you can sell your Amazon stock, trigger the gain, buy it back, still have your Amazon stock, but take money out there.
Right.
Or crypto.
Or crypto.
There's a lot of people who made a lot of
Yeah,
money
we
with crypto.
were talking to some big crypto guys. There's a lot in that space. Or the other thing is, if you look at your realized gain loss report, you can run your realized gain loss report on your stock portfolio and your unrealized gain loss report. Even if you have $1 million in gains and $1 million in losses, you're thinking, oh, I don't have any capital gains. Now, you can take your $1 million in gains, put it in there. The losses roll forward till 2026, just like the passive losses we were talking about. You still, so the smart money is looking for ways to trigger gains. The opportunity zones are so pervasive that if you're holding an apartment complex or an industrial building, and you're in a place where you're going to pay tax on it, I can almost, find a comparable project in an opportunity zone. And you can sell your existing thing, trigger the gain, get some liquidity out, take the gain, and go. I mean, if you love apartments, we have a ton of apartments. That's our main focus. They're defensive. But right now, you're owning apartments where you're going to pay tax. You can, do a transaction, trigger the gain, buy some apartments and develop some apartments, rehab some apartments where you wouldn't pay tax. And if you're convinced that real estate is a great asset class, and it is, and apartments are a great little subclass, which they are, I can show you how you can take your existing stuff and turn it into, apartments on steroids, you know?
It's fantastic. I'm waiting for you to say you guys are going to buy a sports arena next. You got a casino so far, and that would be a good one. I'm telling you.
I know someone who's doing that.
Yeah.
I know someone who's doing an opportunity zone, sports arena, sports franchise.
Yes.
Wow.
That's incredible.
Would that be an example of a qualified opportunity business?
Yes.
Because they're situated within
You can actually do this with an operating company. You don't have to do this with real estate. The smart money is almost all in real estate, and that's because Section 1202 and Section 1045 of the code already give startups the ability to take $10 million tax-free capital gain on a qualified small business startup, which is any C Corp under $50 million when you acquire your interest in it and you acquire it directly from the company for cash or services. And so there's
already provisions that are
right. So we've been playing in that with those provisions in Silicon Valley and tech startups forever.
Long time.
And so and it's only a 5-year hold, and there's no geographic limitations. Whereas the op zone requires you to perform the services. If you're an operating business, you have to do it in the zone. You have to add up your subcontractor hours and all this stuff. And it's a 10-year hold. Just take 1202 and 1045, take the win. You got 10 million per tax or per investor, or 10 times your basis. So if you drop $2 million on some startup, you have 20 million in tax-free gain. under qualified small business stock.
Okay.
That's why the smart money is
on
not
the real
doing
estate.
operating businesses.
Yep.
They're doing the real estate.
That makes sense.
Because they already got tax-free gain on the equities.
Right.
Now you can have tax-free gain on the real estate too.
Yeah, it's amazing.
That is super cool.
Well, I think we've probably.
Yeah, well, you were right. This has definitely been our most informative podcast for sure. It's also been our longest. This has been awesome.
Yeah, that's good. Thank you, viewers who've stayed with us.
Thank you.
I mean, I think the people who are interested in this will engage with this. And
Oh, absolutely. And I can tell that there's even more rabbit holes that we could drill down, and maybe we could continue that discussion in another venue or on another podcast episode in the future.
I'd love to, guys. Thank you for the invitation.
Thank you so much
really respect what you guys are doing here. This is an awesome podcast, and it's great to be part of it.
We appreciate you coming.
Thanks.
Well, that's awesome. Thank you.
Thank you
I
so
had
much.
fun.
Yeah, you are a wealth of knowledge. Holy cow. And you're passionate about it. See, there's two different things, right?
Right.
You care about it, and you care about helping other people make money. And
Yeah, and it's not just about that. It is really about changing the communities, and we didn't get to touch on that too much, but dude, we are changing lives.
Think about the one downtown.
We are creating hundreds of American jobs, changing lives. The head of the Economic Development Association of Western Nevada called our Opportunity Zone project in Reno an economic dream come true and the biggest news to hit downtown Reno in decades. There are people who work there. We have asbestos and lead and mold and all this stuff. We needed an army of workers. There isn't enough.
just for remediation.
There isn't enough certified people in the state of Nevada to do what we needed to do. So we needed to hire, train, house, and feed an army of workers to do, and they're nearly done. We had one tower that's new enough it didn't have asbestos and had 390 rooms. 150 of those rooms are occupied by our workers.
I love it.
We retained some of the hospitality staff. There's tons of kitchens, all the room service kitchens,
Yeah.
We're cooking 2 meals a day for these people, training them and getting them certified.
These are all expenses that are written off.
Of course.
Yes, of course. Man, what a cool.
Jack, you were looking for a hook. Here's the hook.
I mean, we're changing lives
Yeah, you are.
and changing communities. And
Yeah.
that's the coolest part of it for me.
Right.
And we're recycling old buildings.
Right.
I got a building in Tacoma. Oh, dude, I love this. This is such a cool old building. It was the tallest building on the West Coast when it was built 110 years ago, 120 years ago. And we're completely remodeling that. I mean,
This is so cool. So, do brokers bring you stuff too? Ever?
yeah, we get deals from brokers all the time.
Obviously,
I
you get
look at
everybody.
so many deals.
So many people are probably bringing you
Dude,
deals.
we look
Yeah.
at so many deals before we, but it's such a good position to be in
Yeah.
because we can be incredibly picky. And we've got development partners who bring us all of their op zone deals because they know we're the easiest, quickest way to
So
get
you
that
get
deal.
first look.
We get first look.
Always.
Doesn't hit the street. It's an off-market transaction.
Yeah. Every developer who's doing it was they probably acquire some or get stuff under contract just so they can bring it to you.
Yeah.
All the
and
time, I'm
and we
sure.
look at lots of them, but we're incredibly selective about what we pick. And we're on the side of the investor. So I really, we've talked about doing our own development in-house and bringing in people and all of that. And I'm like, that's just going to make us too much like.
It's a little counter to the model, isn't it?
Yeah,
that
I
you set
really
up?
like, in fact, Griffin, we ended up on the name Griffin in our name, which is the G, because it's a symbol that was a
Griffin,
guardian of
picture it,
wealth in mythology, but it also was a Christ symbol, which is why you'll see it on medieval chapels or on
know that.
crusaders' crests, because Jesus is Lord of heaven and earth. So the mythological beast that embodied the Lord of the jungle, the lion, and the Lord of the skies, the
Wow.
eagle, combined. That's why it's on crests
no idea. I
and
love that.
chapels.
Some chills there. I didn't know that either.
And so we're like the white hat guys. We're like trying to, this industry, you guys know, there's so many people in this industry who are just,
Out for number one.
and we're like all about guarding our clients' wealth. And they've been with us since the 90s, some of these guys. One of my clients is the current U.S. ambassador to Finland, which is he's not even our largest, he's our third largest, which is no small, assignment.
That's a title. That's nobility.
Right now, with everything going on right on the border with Russia.
Right.
And you guys are down in Eagle, and how big's your office? Is it 3 guys, 4 guys?
It's me, Philip, Brian, Ebenezer, Nick, and that's it in the op zone side. There's an employee who worked with us on the conventional wealth management, like stocks, bonds, mutual funds, who is entirely responsible for that stuff. I don't have any involvement with it. I have no idea what he's doing, but he's still managing the money for our old clients there. Okay. And then we have a lot of partners out there. A lot of like there's thousands of employees on the if you count up all of the entities
projects. Yep.
that we've got, and we've got projects from Washington. We've got one in Bremerton, Washington. That's waterfront.
Bremerton, that's crazy. I know where Bremerton is.
You know where that is?
I have a student who was from Bremerton, Washington, when I used to be a professor.
No way.
Yeah.
That's so cool.
Yeah, he was always telling me about Bremerton. Just one guy.
Well, the naval base is there, and it's booming. They're expanding it. And there's a ferry that goes to Seattle. And it used to take an hour, and it now takes 28 minutes. They put a high-speed ferry in.
Oh, my gosh.
28 minutes. We bought the parking
exploded.
lot where the ferry used to park. We used to park to go to the ferry, and we put subterranean parking, 2 towers of apartments, and a bunch of restaurants on the ground floor. Waterfront yacht club views.
Right.
Yeah, people
Half
doing
an
that.
hour
28
from
minutes
Seattle.
from Seattle. What an investment.
No tax.
This sounds so fun.
That's
I want
awesome.
to come join you guys. It just sounds like every day is so exciting. You're right. You're changing the world. You're shaping communities.
It's so fun.